Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
And today we are getting right into our deep dive into the source material from this past week. It is mid-May 2026, and look, the UK is experiencing this massive collision of high-stakes politics and really aggressive financial regulation.
Yeah, it's been a week, hasn't it? I mean, if you work in retail banking strategy or compliance or risk, you are probably feeling the whiplash.
Completely. Because on one hand, we've got surprisingly resilient economic data, but then literally 48 hours later, the markets are panicking, the pound is slipping, and the regulators are, well, they're basically handing out lifetime bans.
Right, and our mission today is to unpack all of this. We've got the 2026 King's Speech, we've got fresh Bank of England data, some really dramatic FCA enforcement notices.
And that massive break in political news out of Westminster.
Exactly, and the goal is to figure out how the UK is fundamentally redefining economic security right now.
Yeah, so whether you're trying to understand the market jitters or you're tracking regulatory compliance on the ground, this all connects back to you. The macro politics are directly bleeding into the micro-reality of consumer finance.
Spot on. So, where should we start?
Let's start with the macro picture because the contrast here is just staggering. The Office for National Statistics reported that the UK economy actually defied the global drums of war, specifically that ongoing conflict in Iran.
Right, the 0.6% GDP growth in Q1.
Exactly, 0.6% growth. Structurally, that shows a really sturdy economy. But then you look at the 2026 King's Speech, and the tone is just completely different. It's all about threat and fortification.
Yeah, the King's Speech was a massive pivot. It essentially introduces this new philosophy of the active state.
The active state.
Yeah, it's a total departure from light touch regulation. The government is essentially saying they need to aggressively shape the market to protect national security.
I mean, you see that in the Energy Independence Bill.
Right, which explicitly ties climate policy to national defense. But for banking professionals, the big one is the Hillsborough Law.
Oh, the duty of candor?
Exactly. The Public Office Accountability Bill. It introduces a strict legal duty of candor for public servants. It shifts transparency from being just a nice moral expectation to a hard legal requirement.
Which is a fascinating cultural shift. But the timing of this is what's so wild. Because just as the government is trying to project this unified, fortress-like active state, the political floor completely falls out from under them.
You're talking about Wes Streeting.
Yes, the shock resignation of the health secretary. That completely changed the market temperature overnight, didn't it?
It really did. I mean, financial markets hate surprises. They demand predictability.
Right, and a sudden cabinet departure is the opposite of predictability, especially if you look at the text of Streeting's resignation letter to Sir Keir Starmer.
What was the specific phrasing he used again?
He cited the government's unpopularity in the local elections, and then he explicitly wrote that there was a vacuum of vision and a drift in direction.
Oh.
Yeah, he called for a battle of ideas. And then literally within hours, Andy Burnham, the mayor of Manchester, announces he's going to stand in a by-election for Makerfield to get back into Westminster.
Which the markets instantly read as the opening moves of a major leadership challenge.
Right. It signals a fundamental debate over the economic direction of the governing party. And the market reaction was just instantaneous.
Borrowing costs spiked immediately.
Yep. 10-year gilts hit 5.09%, the 30-year hit 5.76%, and the pound slipped. It's like the UK economy is this sturdy ship, but it just had a sudden internal mutiny.
That's a good analogy. And to understand why a political resignation makes borrowing so expensive so fast, we need to look at Catherine Elliman from the Bank of England.
She gave a really crucial speech recently, didn't she?
She did. She laid out the underlying vulnerabilities of the UK's balance of payments. Look, the UK runs a persistent current account deficit. We import way more than we export.
So we have to plug that hole with foreign capital.
Exactly. We run a financial account surplus. We are entirely dependent on attracting foreign investors. And Mann pointed out that foreign investors now own about 30% of UK government bonds.
Wow, 30%.
Yeah, and over 50% of UK equity. So these foreign investors, they don't have local loyalty. They don't care about domestic Westminster drama.
They just see instability.
Right. They see a cabinet minister talking about a vacuum of vision and they act like torchy activist shareholders. They immediately demand a higher risk premium to hold UK debt.
Which is why those gilt yields spiked to nearly 6%.
Exactly.
Yeah.
Our reliance on foreign capital makes us hypersensitive to domestic political shocks.
So if you're listening to this and wondering why your bank's borrowing costs or mortgage rates are jittery, it's directly tied to that political drama.
It absolutely is.
But let's transition from the macro level to the ground level.
Yeah.
Because while the government is trying to be this active state at the top, the financial regulators are showing some serious teeth on the ground.
Yeah, they are executing what they call a dual-track approach to enforcement.
Right, active enforcement. What does the dual track actually mean for compliance teams?
It means the FCA is pursuing civil and criminal angles at the same time. And the big takeaway here is that technical compliance is out. The FCA is now using personal integrity as a direct proxy for firm culture.
So you can't just tick the boxes anymore.
No, absolutely not. If the regulator thinks you lack honesty, having your paperwork in order will not save you.
I think the Frank Brewer case is a perfect example of it.
Oh, absolutely. The Blue Ski Wealth Management case.
Yeah, so Brewer just got hit with a staggering £755,000 fine and a lifetime ban from the industry.
A lifetime ban is huge.
It is. He was conducting defined benefit pension transfers, 16 of them, actually without professional indemnity insurance.
So he was knowingly exposing clients to uninsured risk?
Exactly.
Yeah.
Over £1 million in uninsured risk. But it's what he did after he got caught that is so wild.
Right. The cover-up is always what gets them.
So the FCA finds out the insurance lapsed. They slap Bluesky with a voluntary requirement, a VREQ. Brewer ignores it. So the FCA imposes a formal asset requirement to lock the firm's money down.
Which is literally a legal order saying you cannot move or diminish the firm's assets so victims can be compensated.
And he just completely ignored it. He stripped over £800,000 out of his firm and funneled it into his personal account.
Just brazen asset stripping.
Then he liquidated the firm. He just took the money and ran, leaving the financial services compensation scheme to cover over £214,000 in liabilities.
Which, by the way, is funded by levies on honest firms.
Exactly. So is this essentially the ultimate blueprint for what the FCA considers phoenixing a company?
Yes, 100%. It is textbook phoenixing. And the FCA is using this case as a massive warning. Under the senior managers and certification regime, if you try to outrun your liabilities and leave the public holding the bag, they will come for you personally.
Hence the £755,000 fine?
Right. They calculated that specifically to strip him of every single penny he took.
Wow. And then there's the criminal side of this enforcement mandate. Let's talk about Richard Faithfull.
Yeah, this is a really grim one. Faithfull was convicted back in 2021 for laundering £2.5 million for overseas boiler room frauds.
And he actually got released from prison in June 2025, right?
He did, but when he was originally convicted, he was hit with a confiscation order for £529,000.
To strip the financial benefit of the crime.
Exactly. But he didn't pay it all back. He still owed around £180,000, so the FCA just dragged him back to court.
And they activated his default sentence. They sent him back to prison for an extra 499 days.
Just for failing to pay the order, the FCA's head of enforcement was brutal about it, basically said, you try to evade justice, you go back behind bars.
And we shouldn't lose sight of the human cost here. The sentencing judge's quote really stuck with me. He said the victims' funds flowing into Faithfull's accounts were simply being slaughtered.
Simply being slaughtered. Yeah, that's chilling.
It really is. And it explains why the regulators are being so uncompromising. We're seeing it in corporate accounting, too.
Oh, the Carillion directors.
Yeah, the FRC finally closed that 8-year saga. They banned former finance directors Richard Adam and Zafar Khan for 15 and 10 years.
It just shows the whole regulatory landscape is focused on absolute corporate accountability right now.
Okay, before we move on to how the industry is actually fighting back against all this, let's take a quick pause. If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
We really appreciate the support.
Right, so we've talked about the reactive stuff, catching the bad actors after the fact. But the sources also show this massive shift toward proactive systemic defense, don't they?
Yeah, they do. And this is where the tech comes in. The FCA is doing this new public-private data fusion initiative.
Data fusion? That sounds very sci-fi. What does it actually mean for a retail bank?
Well, the FCA is teaming up with the National Crime Agency. They are sharing over 5,000 intelligence records via the Police National Database.
Wait, really? Just dumping 5,000 records into a police database? How does anyone actually filter that noise to find real crime?
That is exactly where advanced network analytics comes in. Traditional compliance relies on static rules, right?
Like flagging any transaction over £10,000?
Right. But highly organized international crime farms don't do that. They use smurfing. They split the money into tiny microtransactions and push it through hundreds of mule accounts.
To stay under the algorithm's radar.
Exactly. So by fusing FCA data with NCA intelligence, they use AI to map the whole network. They look for, say, 50 unrelated accounts, all sending £20 to the same overseas crypto wallet at the exact same time.
Oh, wow. So you can only see the web if all the agencies pool their data?
Precisely. It's a shift to intelligence-led disruption to stop these crime farms that are causing average consumer losses of over £25,000.
That is massive. But it's not just high-tech international crime they're targeting. Retail banks are also being pushed to fix how they handle the human element.
Yeah, protecting the vulnerable. The FCA's bereavement review was a really tough read.
It was. Only 47% of bereaved customers actually felt supported by financial firms. That is a terrible statistic.
And the FCA blamed it on a rigid culture of paperwork. Look, probate is complex, but banks are making it worse.
They are making grieving people navigate siloed departments, bringing physical death certificates into multiple branches.
Filling out the same forms 5 times, it's just a lack of empathy in the process design.
But on the flip side, we saw a brilliant example of proactive consumer defense in the sources this week, Nationwide's new hide reference feature.
This is such an important innovation. Economic abuse cases are skyrocketing. They hit 312 in 2025 alone.
And the mechanism abusers are using is just awful. They exploit the faster payment system.
Right, that 18-character reference field you use when you send money.
Yeah, abusers are sending micropayments, like literally a penny, just so they can type harassing or coercive messages in that reference box.
Knowing it will permanently show up on the victim's bank statement, it is a disgusting weaponization of a standard banking feature.
So Nationwide has built this hide reference tool that lets victims actively block those references from showing up on their app.
And they backed it up with physical safe spaces in 430 branches.
Which is exactly what holistic integrity looks like. It's not just, are we technically compliant? It's, how is our system being used to cause harm, and how do we engineer it out?
Exactly.
But look, I have to play devil's advocate here.
Go for it.
We're talking about data fusion with the National Crime Agency, the FCA tracking personal assets, banks having to engineer bespoke solutions for domestic abuse. How are normal firms actually coping with this?
Well, the short answer is they are really feeling the friction. The Bank of England's 2025 Firm Feedback Survey proves it.
What did the survey say?
The PRA surveyed over 400 firms, including credit unions for the first time. And sure, firms praised the PRA for being approachable.
But there's always a but in those surveys.
Oh, a massive but. Firms explicitly demanded more proportionality. They want regulators to focus on primary risks, not just blanket enforcement for minor administrative slip-ups.
Which makes sense. If you run a small firm, you can't have the same compliance overhead as a Tier 1 bank.
Exactly. And they also complained about overlapping data demands. The PRA and the FCA asking for the same data, but in different formats.
That sounds like a nightmare for the risk teams.
It is. But if you look at the recent action against King's Crown Finance, it's clear the regulator doesn't care if you're feeling squeezed.
Let's unpack that, because King's Crown Finance is an Annex 1 firm.
Right, which historically flew completely under the radar.
Yeah, Annex 1 firms aren't fully authorized. They just do things like commercial lending. They don't hold retail deposits.
But they are subject to money laundering regulations. And the SCA just slapped voluntary restrictions on them, stopping them from onboarding new customers.
Which sends a huge signal. The FCA is sweeping the far corners of the market. Nobody is flying under the radar anymore.
No one. The perimeter of regulation is expanding, and the tolerance for failure is shrinking to zero.
So let's recap and bring all these threads together for everyone listening.
Yeah.
The core takeaway from mid-May 2026 is that the UK is aggressively fortifying its economic walls.
From the very top down to the bottom.
Exactly. From the king announcing an active state, to the FCA throwing asset strippers and money launderers back in jail, to retail banks building digital shields for abuse victims.
Technical compliance is out. Demonstrable integrity is in.
Right. If you work in risk, legal, or compliance, that is your mandate this week.
And I just leave you with a final thought to mull over. We've seen this active state aggressively policing the market to protect consumers and national security. But as geopolitics stay volatile, where is the line?
Between a safe market and an over-policed one.
Exactly. Will this absolute pursuit of integrity end up stifling the very economic growth the government is trying to protect?
That is a brilliant question to end on, and really the ultimate tension at the heart of the active state.
Absolutely.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.
Trying to practice like in paid my crap, then back and never